Hello, everyone. Welcome back to Financial Clarity for Doctors. This is Rachelle Vanderzanden here with Corey Janoff.
I'm here too.
Woot woot. It is summertime. There are kids and dogs in the background. It's a little crazy up in here. We last time recorded an episode about charitable giving, and then the one big beautiful bill act thing passed, and now it's different. And so we thought, well, maybe we should update people since what we said before is slightly incorrect. Some of it is still very applicable, but other things have changed. So we're going to talk a little bit about some of the changes to charitable contributions, but also some of the other changes that may affect you all, including things like student loans, which is a big deal for many of you. But we're going to start just by talking about some of the updates to the things that we already told you that are incorrect. So, Corey, take it away.
I'll take it away. Yeah, that was a fun one. We record these episodes in advance in case you're not already aware. And we have to do that, one, just to get ahead of things with scheduling. But two, compliance. All these episodes have to be reviewed and approved by compliance before they can be published. So typically we're recording about a month ahead of time. Um, and it doesn't take a full month to review, but we like to get ahead of things. So have an episode or two in the hopper in case whatever we miss a scheduling date or a recording date. So yeah, we recorded, and then the One Big Beautiful Bill Act passed. It's big. Not sure how beautiful it is. I guess beauty's in the eye of the beholder. Um, but they changed some things with charitable giving, which was, I guess, in some cases good, in some cases bad, depends on your circumstances. Kind of like all tax updates or any new laws that are enacted. It'll benefit some people, it'll probably adversely impact other people. So the big things with charitable giving starting in the year 2026, you can, for people who take the standard deduction. So there's, when you file your taxes, you automatically either take the standard deduction or you itemize, whichever is going to get you the greater tax break. That's what you do. The standard deduction is, what is it, 15,000 a person starting next year? Is that right?
Yeah, it's a
Um,
little over 15,000 per person and 30,000 per couple, I think, because it's indexed for inflation, it goes up like a tiny bit
yeah, I
every year.
think
But this
this
year it's 15 and
it's
30. Yeah.
exact. It might, or slightly less, whatever. Call it 15. Easy round number. And then it's going to go up over time with inflation. So if you're married, filing jointly, you can take a $30,000 deduction, regardless of if you have a mortgage or anything else. If you do have a mortgage and have state income taxes and other things that you can deduct, if those itemized things that are eligible exceed the standard deduction, well, then you're going to itemize. If the itemized things are less than the standard deduction, you'll take the standard deduction. So previously, if you took the standard deduction, charitable contributions weren't deductible. You only can deduct them if you itemize. So now, under the new rules, starting in 2026, if you take the standard deduction, you can deduct $1,000 per person for charitable contributions. You have to give at least that much to deduct it. But if you give at least $1,000 per year, you can deduct 1,000. And if you're married, that's $2,000 per household. So that's a big benefit for people who don't itemize but give a little bit to charity every year. You can now deduct some of those or all of those charitable contributions, depending on how much you give. Now, if you itemize, you're only allowed, starting in 2026, only allowed to deduct charitable contributions that exceed 0.5% of your income. And I think that's adjusted gross income, Rochelle, right?
Yeah. Yep.
Yep. Um, and the maximum tax bracket or deductible rate is 35%. So if you're in the top federal bracket of 37%, meaning as a married couple, you're making over 750,000 a year or more with, the AGI thresholds, you would have to give at least $3,750 to deduct anything. And the deductions capped at 35% rather than 37. So it actually is somewhat harmful to higher income earners in that you're not going to be able to deduct as much of your charitable contributions, and you have to give a larger amount to be eligible to deduct it. Again, 0.5% of your income. If you give less than that, not deductible. So not moving the needle a ton, but a little bit of an annoyance for folks that give to charity. It's not going to be as deductible as it was before for many of you. But there are some
Or,
strategies that we
yeah,
could deploy to make it more attractive for you.
yeah. And if you're a lower income earner or, you just don't even need to itemize that $1,000 per person is actually probably really helpful, which is nice because it would have been previously that you just weren't able to deduct anything, at least at the federal level. Yep. I think some of the strategies that we discussed last time will still be very helpful. Like lumping contributions into a single year. Like if you're planning to give $20,000 per year over 5 years, doing a lump sum of 100,000 in one year will yield like a higher deduction. Using things like donor advised funds to do that can be really useful. And you can listen to the previous episode if you just want to hear a little bit more about that. But there's lots of different ways that you can still strategize, but you may be, again, limited when you're just doing your regular giving. If that's kind of built into your cash flow and it's a couple $1,000s a year or something, it may or may not be beneficial from a tax planning perspective for you to do that anymore.
And
Yeah.
yeah, it might also make sense if you do have a sizable amount in the bank account or some appreciated stock and you wanted to give to charity this year in 2025, there's a little extra incentive to give a little more this year because it's still fully deductible at the top tax bracket too. So if you're already planning on giving some money this year and even next year, maybe try and lump it all into this year because you're going to get a little bit more of a deduction that way by doing it all in 2025 before the new rules take effect.
Cool. So we're going to talk about a couple of other high level things that have changed with this new bill. One of them is that a lot of provisions from the Tax Cuts and Jobs Act in 2017 that were set to expire at the end of 2025 have now been extended permanently or until they get changed by a new law, basically. But the tax brackets had been lowered a little bit. That's now permanent. The higher standardized deduction has been made permanent. The estate tax exemption amount being like 15 million per person and up to like 30 million per couple. Again, indexed for inflation, so that number changes a little bit, but that's also been made permanent. So again, all of these things are now, there's no like end date set in place for them. They could end at some time. Tax law changes all the time when we pass new laws and things like that. But for now, that is what it is, and it won't change again until something happens to make it change, basically.
So probably at least for the next 4 years, it's going to be
Oh, for
permanent.
sure. Yeah, or the next 3 years or whatever. Yeah.
Yeah,
Yep.
and then whatever
Green. Yeah, I don't
regime
know.
is in office next, they're going to want to make their own tax laws
Yeah,
and
they're gonna be like,
changes.
this was crap for whatever reason,
Yeah.
or not, who knows? But yes, there's definitely the potential that with a new administration, there are changes to these tax laws.
Yeah.
Like
And no
yeah,
guarantees. Like it doesn't, just because you get a new administration doesn't mean all the rules and laws change. They'll keep the ones they like, try to change the ones they don't like. Some of it depends on the makeup of the House and the Senate, politics, fun stuff. Um, but yeah, so permanent doesn't mean permanent.
right.
Just means
There's
indefinite
no end date in sight.
until
Yes.
a new law changes it.
Yeah.
Whereas, as Rachelle mentioned, the previous Tax Cuts and Jobs Act that went into effect in 2017 was set to expire at the end of 2025 and would have reverted back to the old rules had a new law, aka the
Not been passed.
OBBBA,
Ooh,
came
ooh, ooh.
into effect. Um,
Just rolls off the
another,
tongue, right,
yeah,
Corey?
yeah, the one big beautiful bill act, the OBBB.
Yep, that one.
Anyways, another one that changed to a lot of people's benefit is the state and local tax deduction. That was one of the big below the belt punches that Trump gave to all the blue states in 2017 was capping the state and local tax at $10,000 because previously you could deduct your state income taxes from your federal taxes. And if you lived in those higher cost of living coastal states, you probably had pretty high state income taxes.
Hmm.
Uh,
And
and if
property
you're,
taxes, and yeah,
yeah, so if you're making a high income, if you're in California, Oregon, New
New
York, New
York.
Jersey, and you're making a high six-figure income paying 10% state income tax, I mean, you could be paying 50, 60, 70, 80,000 a year in state income tax that used to be deductible. And then the new laws passed and you could only deduct up to 10,000 of it. So now that state and local tax deduction is temporarily increased from 10,000 to 40,000 until 2030. However, if you make more than $600,000, you're still capped at 10,000. Um,
Hmm.
if you make under 500,000, you could take up to the full $40,000 deduction. Between 5 and 6, it gradually slides downward.
Yep.
So for if you're again making a high six-figure income or more, doesn't benefit you. If you're making a mid to low six-figure income, it benefits you
Hmm.
if you have state income taxes.
Yep, for sure. Or even like, yeah, the state and local taxes too, but yeah, I think it's mostly beneficial for people who have state income taxes, for sure. One thing that's going away, and I'm sure most people have probably heard a lot of this in the news, but they're doing some pretty dramatic cuts to credits for like green energy. So, energy efficient home credits are going away. EV, like electric vehicle credits, are going away. And I think that's as early as September of this year. So, that like that list of cars that you could potentially buy and qualify for like a $7,500 federal tax credit, no more. That's going away. So those are all being repealed and or phased out starting as early as this year, and then most of them will be gone starting 2026 tax year. So if there are things that you were wanting to do to your home already, it's not like, hey, let's go spend a bunch of money on solar panels we weren't planning on buying because now we want a federal tax credit and we might not get them later. But if it's something that you were planning on doing, like it makes sense to be timely about it and just look into like what you can qualify for right now when maybe you can't qualify for that, if this is something that makes sense for you to do in your home, all of that kind of stuff, because those credits will not be available anymore
Yep, yep.
for now.
For now.
With this law.
Yeah, student loans. So
Ugh,
we'll talk a couple things student loans here. One, the borrowing of student loans, which for most of you, you've probably already taken out your student loans, but you might have children that are going to be
it could
going to
affect your
college.
kids
Could
for
affect your
sure.
kids, or maybe you're in college or med school listening to this. Starting, I believe, July 1st, 2026 is when the new student loan caps take effect. They're capping it at $100,000 for grad school, $200,000 for professional school, aka med school, law school, etc. And there's a lifetime federal loan limit of 257,000, and that includes undergrad loans, if I'm
Mhm.
understanding it correctly. So
I think so.
be a little more prudent with where you're going to get your education if you need to take out loans to borrow it. The Parent Plus loans are capped at 65,000. So essentially, the federal government's not going to write a blank check for you to go to college or get a medical school degree. Um, which probably means there's going to be an influx of private lenders willing to lend money for school at maybe better, maybe worse terms and rates than the federal
Hmm.
government will lend. Probably not eligible for loan forgiveness. Um,
Definitely not.
but well,
Yeah.
who knows? You know, there
I
might
mean, I
be
guess
some.
there's yeah, not like PSLF type loan forgiveness, but maybe it still qualifies for like National Health Service Corps or like the VA's
Yeah.
EDRP. Like there are some programs or forgiveness programs that private loans can
Or like, who
potentially
knows?
qualify for.
Individual states might be like, "Hey, we'll lend you money,
Yeah.
but you have to come work in our state
Yeah.
on a, rural underserved community health or Indian reservation or something for 10 years, and then we'll forgive your loan." So there might be some of those, um, but anyways, I would like to think this will maybe put some pressure on colleges to stop raising their tuition rates like they have been and make it more reasonable. Maybe not lower
Hmm.
the cost, but at least slow down the increases because otherwise, 20 years from now,
Yeah.
no one's going to want to go to college. It'll be too expensive.
I was also reading something very briefly about this. I didn't make any notes about it because I was like, what? Are they going to even enforce that? But there was something about holding universities accountable for like the percent, like how much income their graduates are earning in specific programs. So if there's like a specific program where like people come out and they have loans and they're not making money at all, like they're basically saying, okay, you didn't prepare your graduates well to go into the workforce and make money, and this program is not working, which obviously like making money isn't the only point of anything, but at the same time like the federal government is saying you got to prove that you're preparing these people to live in the real world. So I don't know. We'll see how and if and when that sort of provision can be enforced and how they determine that they measure that, because I don't know how you would do that necessarily.
Yeah. I think there have been some lawsuits in the past, kind of one-off cases where
Hmm.
students allege that they were promised to have a job or, promised, hey, our grads
Yeah,
make this much money when they graduate and 5 years out, 10 years out. And I think this was more common like in the 2010s when,
with like the
after
small
the
private. Yeah,
great financial crisis when, no one had jobs coming out of college and people weren't making as
yeah,
much. People with law degrees were working at McDonald's. I mean, some of this is all anecdotal. It wasn't the norm, but still. So
yeah, yeah.
yeah, hard to enforce. I don't know. But I would like to see some. I mean, some of it's on the students, some of it's on the
Yeah.
school. Like it's not all one or the other. Like if you're
Yeah.
taking out $400,000 to get an art history degree from a private school, like, I mean, come on, that's on you. If you're not making a lot of money.
I mean, if you have parents who are willing to bankroll that, like whatever, I guess.
Yeah, but I don't know if that's the school's fault if you're not making a lot of money. But like if
Right.
you go to Harvard and pay Harvard tuition to get a business degree and you're not making I mean, that's still probably on you. Like if you have a Harvard degree, you're getting a job.
Yeah. Well,
Like,
and I think that's why it's more of like an average across the program.
yeah,
Like, if your graduates are generally making good money and there's a few that aren't, like, okay, well, that's not your fault.
yeah.
But yeah.
So,
Okay. So the other big change to the student loan landscape that I think we have heard a lot about and I think is still somewhat confusing is just the student loan repayment plans are being updated. Moving forward for any loans taken out like for this coming academic year, so like 2025, 2026, there will only be two options available for borrowers who have loans taken out like after this time, basically, like after right now. And those two options will be the 10-year standard repayment option or the new RAP plan. And the RAP is like RAP. So that's the only other option. That one is the one that will be income driven and it will go into effect sometime before like July 2028, like the payment plan itself. But the calculation for that is very different from the existing income driven repayment options. Those ones are based on a percentage of your discretionary income. So the federal government is like, you need this much to live. We will take 10 or 15% of the rest of it, right? But with the RAP plan, it's now 10% of your AGI, so your adjusted gross income, not your discretionary income. So if you're making 30 grand a year, and you can barely pay rent, they still are going to want their $3,000 a year. Like that is how it will be calculated. It's also going to be harder to qualify for like deferment and forbearance and things like that. So I think it's very, very prudent for borrowers right now to be thinking like, how am I going to pay this back when I get out of school? Because it's there will be less options to not do that and to minimize your payments. With the rep plan, there will be an interest subsidy if your payment does not cover all the interest. I'm not quite sure exactly how that works, but it seems like that will be helpful for, residents and fellows so that your payment or your loan balance doesn't balloon extraordinarily while you're in training. And then that was the plan that will qualify for PSLF or a 30-year taxable forgiveness plan. So if you're making payments for 30 years and you still have a balance at the end, it can be forgiven, but that amount will be taxable. So those are the only two for new borrowers. That's it moving forward, at least how the law is written now.
do you know, if you start with the wrap plan, can you then switch to the standard 10-year plan?
I haven't seen anything that says you can't, so I would
Yeah,
assume
because
so.
I'm thinking like, all right, do the wrap plan while in residency, and
For
then say
sure.
you're making four
I
hundred
mean,
thousand
that's
a year, your payment would be 40,000 a year, but the standard
right.
10-year might only be 20,000 a year at your loan balance. Like I'd rather pay 20
You
than
can do it
40.
now, and I haven't seen
Yeah.
anything calling out like this is changing, so I would expect that that's the case. But
Yeah. So
again,
probably
that's something you
still
should look at.
the scenario, whatever the lowest payment option is, if you're pursuing PSLF, go with that one. Whether
Yeah.
that's which
Yeah.
for existing
Yeah.
borrowers, so not new borrowers,
People
it
who
sounds
already have loans. Yep.
yeah. If you already have loans, you're already on a payment plan, you're very confused because so much has changed over the last year and so much has been in limbo. It sounds like you have to transition to one of the new plans by July 1st, 2028. So this new RAP, which I think stands for Repayment Assistance Program, doesn't even
I think
exist
so.
yet. They're going to eventually roll it out. They're giving
Yeah.
themselves 3 years to roll it out
I
because,
think they're planning to roll it out soon, but it's
yeah.
just like you don't have to transition to it
Okay.
like soon. I think it's like next year is when they're
Yeah.
rolling it out. But
But
yeah.
but I think IBR is still an option for you.
Yeah.
You can still qualify for the 20 or 25-year forgiveness plan under the current IBR rules. I think it's
Yeah.
20 years if your loans were taken out after 2014, 25 years before 2014. So,
Mm-hmm.
if you have existing loans, a little more flexible,
Mm-hmm.
still go with whatever the lowest option is. Because I assume IBR still qualifies for PSLF.
Yes.
Uh, so
Mm-hmm.
yeah, go with whatever is going to result in the lowest payment to get you to PSLF if you're pursuing PSLF. But with
Right. I
some
do
of,
think,
go ahead.
yeah, one thing I want to just mention is that like you won't be able to qualify for pay as you earn like starting 2028 or something like that. And I think a lot of people have gotten like letters and instructions from the Department of Education saying, hey, like if you're in SAVE, you need to like switch into a qualifying payment plan to be able to start making payments towards PSLF, which may very well be the case. It may be that you're able to buy back the payments from this forbearance during like the SAVE plan limbo, which has been crazy, but who knows if that will be a thing or not. But when it says like you have to, like we encourage you to switch into a payment plan that's going to be around post 2028, you don't have to do that. Like you can enroll in pay as you earn if it's going to be a lower payment right now. If you can be in pay as you earn from now until 2028 and then switch into IBR or RAP at that point in time, like that probably makes more sense. So, do the thing that makes sense for you based on your situation, whether that's like waiting it out to try to buy back payments, switching to pay so you can make some kind of lower qualifying payments if you're able to, switching to IBR for whatever reason if that's a better fit for you. Just like pick the plan that works best for you right now. Don't rely on the Department of Education to tell you like, "Hey, you're going to have to do this eventually, so you might as well do it now." Like, no. They can figure it out.
But starting in August, which will be when you hear this episode,
Yeah.
is when interest starts accruing on your save plan. So unless you're pretty close to 120 months and can do the
Yeah.
buyback option, which if you're unfamiliar, the buyback is under save. If you
Not even
haven't,
just save. It's like any,
oh, really?
yeah, it's
I thought it
not
was
it's not
specific to
specific to
save.
save. Mm-mm.
Oh,
It's any like forbearance that you didn't get credit for, basically.
okay.
Yeah.
And you don't have to be on save to do
No.
that. Okay.
No.
Well,
Mm-mm.
most of the people who this mostly applies to people on save.
Yeah.
But if you are in forbearance, like you've been in the last year on save, um, and once you get to 120 months of employment, you can, in a one lump sum, pay for those missed months and just catch yourself up to 120 qualifying payments to get forgiveness. But if you still have a handful of years left, probably worth considering switching to one of the plans and getting back on that payment train because interest is going to be accruing on save. And if you're in forbearance, you're not getting credits for PSLF. So
Hmm. Yeah. Yeah. You can't apply to do the buyback until you have 120 payments. And it's just, it's a waiting game. And that waiting game can be painful when there's a lot of uncertainty.
it'll take them 9 months to process. So you're waiting even
That's
longer.
also true. It's not like you get to be like, I want to buy back my payments and you get to do it immediately. They have to like process your paperwork, say it's okay, calculate how much you have to like pay back, and that process is not going smoothly right now. The last time I read it was like they had like 40,000 people had submitted applications to do PSLF and also buyback payments, and they'd processed like 2,000, and that was it. And that's been since this started, and that was like maybe 6 weeks ago. So I'm sure the numbers are even worse now.
Yeah, I think that was like the May numbers. I think it was like
I think it,
1,500 in
yeah,
April. It was like 2 or 3,000 in May. Probably they'll
yeah.
have June numbers soon at some point. So they're improving there, but when only one person's working to process all the applications, you can only do so much.
I know, right? Yeah.
Um, Jokes aside, but maybe there's truth to
Yeah, it's a mess. That's all there is to it. But it's all right. I think like you do what you can to cross your T's and dot your I's, and that's what you can control. That's it. Like, and then beyond that, paperwork processes when it processes.
I wonder if the people processing that or just using ChatGPT to review all these applications. Because can you imagine being in that office, being just hating your job? Like, oh, I got to review and add on my calculator, and or they probably have abacuses and whatever federal office they're
I don't
in.
even know what that is.
An abacus is like what our parents learned to do math on back in the
Oh.
50s. Like the beads that go across. So it predates
Figure
Rachelle
it
and
out.
I. Yeah. But yeah,
Yeah.
if I was there, I'd be like, upload to ChatGPT. Does this look good? Stamp, done.
Yep. Yep. Okay. Beyond student loans, which obviously is a big fat mess, we have some Medicaid work requirements now, which are being increased and kind of phased in over the next few years, which it seems like it can also apply to potentially volunteer work and things like that. But that is new and could affect physicians quite a bit depending on um, what specialty you are, where you work, all of those kinds of things. There's specific services that will not be reimbursed through Medicaid, like some family planning services and things like that. So that could absolutely affect your organization, your job, your income, potentially, just depending on where you live. It seems like it may affect like rural hospitals and areas more than it affects like more urban areas. But it is interesting because that's supposed to be phased in over the next few years, and we will see what happens because hospitals are big and they lobby a lot, and it seems like there's the potential for them to be like, we can't afford this, and you're going to make our hospital closed, and what are you going to do about it, et cetera, et cetera, et cetera. So I think that's one where we're going to kind of have to stay tuned and see how that evolves over time as it comes time to implement those things.
Yeah, it will definitely be interesting.
For sure.
Another
Yeah.
one that's interesting is the new Trump accounts, which I think that's literally the name, Trump accounts. Kind of like Roth IRAs were named after some guy named Roth.
I
But
didn't even know that. That's funny.
yeah, starting in, well, I think so I don't think you can open them until next year. They haven't quite logistically got it all set up, and all the banks and
Hmm.
custodians and brokerage firms are going to have to get set up to add a new type of account registration to their platform. So it's not effective yet, but I think next year is when you'll be able to open them. I think it sounds like anyone can open a Trump account. These are designed for children. Newborns who are born between 2025 and 2028 will automatically get a $1,000 seed funding from the federal government. So heck yeah, if you have a baby
Free
for
money.
free $1,000 for your kid from the government, sign me up. I like it. Um, and it's essentially like an IRA for your kids, which is really cool. They don't need earned income. Like right now, if you wanted to fund an IRA or Roth IRA for your children, they have to have earned income and can only contribute up to their earned income for the year. But it sounds like anyone can open and fund up to $5,000 a year per child. Even if your kid wasn't born between 2025 and 2028 or isn't born in the future, for the next few years. You can still open and fund one, is my understanding. You just won't get the $1,000 credit if you already have a child or if your kid's born in 2030.
Hmm.
Employers can also contribute to these accounts, but that counts towards the $5,000 limit. But I could see that potentially being like a workplace benefit incentive. Hey, we'll fund your Trump accounts for your kids if you come work with us. Um, so the perk is I assume it's going to be tax sheltered, asset protected, just like IRAs. Kids can't touch it until they're 18, and at 18, it can only be used for education or a first time home down payment for up to $10,000. Like I
Hmm.
said, it's basically an IRA. If it's used for anything other than education before age 59 and a half, you're penalized and pay extra taxes. The downside to these is it's an after-tax contribution, and the withdrawals are still taxed as ordinary income rates.
Well,
Um,
the growth is taxed as
oh, sure,
income.
yeah. Well, I guess so.
Yeah.
Yeah, you can take out your cost basis tax free. So you got
So
to
it's
make sure
basically like
you're
a non-deductible IRA.
Yeah, so you got to make sure you're
Yeah.
reporting your contributions so that they have your cost basis tracked. Otherwise, 100% of it's going to be taxable. So you got to report the
Yeah.
contributions to track the cost basis, and then withdrawals are taxed as income. So not the most tax favorable, but definitely a
Mm-mm.
good starting point to fund if you want to fund money for your kids before they start working. And at that point, once they start working, you're better off just funding a Roth IRA for them.
What
Um,
do you think is the advantage of doing this over just like a brokerage account?
yeah, that pros and cons. So that brokerage
Yeah.
account, capital gains taxes on your investment earnings instead of income taxes.
Which is
Historically,
generally less. Yeah.
capital gains taxes are less. However, brokerage accounts aren't going to be as asset protected. So, like,
Yeah.
if you ever get sued, easy to go after a brokerage account, harder to go after an IRA,
Yeah.
low risk.
Right.
So I don't know, pros and cons. I like the free $1,000. I wish they would
For
just,
sure.
rather than
Yeah.
creating a new account, just open a Roth IRA for kids and say, hey, you can put up to 5,000 a year for a child
So
into a
much
Roth
simpler.
IRA.
Yeah.
And when they work, you can do up to the 7,000. I don't know. Like, but I
Yeah.
don't run the world. No one asked me for my opinion.
Yeah, I mean, that would not create as much tax revenue in the future, which would be the downside for
True.
them to do that. Yeah.
Yeah.
Yeah, it seems like the like custodial accounts and things and 529s may be like the best planning option still, but this could be an option, especially if you want a little bit of money that's more flexible for them. Um, and
But
also if you have a child born between 2025 and 2028, you get a free $1,000. Done. Do it.
But I mean, if you think about it and you want to really jumpstart your kids' retirement and you want to make sure it's in a vehicle that they can't touch till
Mm-hmm.
retirement,
Yeah.
like, option
Without
one
tax
is
penalties.
create a trust and put the account in a trust and write the provisions in the trust like, hey, you're not allowed to touch this till you're 60 years old.
Mm-hmm.
No ifs, ands, or buts. You can, that's it. It's a retirement
Mm-hmm.
account. But now you've got, without having to create a trust, you can just set up this account. They can't touch till they're 60 without penalty. You can
Mm-hmm.
fund a retirement account for them in their name if they don't have earned income. Because right now, if you want to truly fund a retirement account for your kid, they have to have earned income. So odds are the earliest is high school, when they start working at McDonald's or a gas station or something.
Unless
Um,
you're paying them to model for you on your website.
yeah. Which on that note, I was actually thinking I want to ask my accountant about this, Rochelle. Like, if
Yeah.
we have our kids
Mm-hmm.
record the intro for our podcast and we pay them
So
an
cute.
annual licensing fee, like, hey, we're going to pay our kids $7,000 a year to license their voice for our podcast, and then we can fund Roth IRAs for them.
Ask away.
I'll ask and see if
That seems
that's
a little
legitimate.
excessive. Just
I mean, if you're paying a actor to license their like good luck finding one that'll license it for less than 7,000 a year. I don't know.
Mhm.
I mean, maybe. We'll see.
Yep. I don't know if that would uphold under an audit situation, but
Licensing
yeah,
fee. It's perpetual. I don't know.
it's all good. Yeah.
Anyways, so yeah, if you can employ your kids somehow, which is
Yeah,
easy as,
if you're self-employed, way better chances you can do that than if
or
you're
you
I mean,
own
if
your
you're not, you can't.
practice.
Yeah.
Yeah, like put a
Yeah.
picture of your family on your company website and like pay them a modeling fee, have your
Yeah.
kids and once they're, you know, 7, 8,
I
9,
mean, we
10,
should
start
just change our
filing.
Affinity group website. I don't even know what that would be from Affinity. But anyway, moving
Well, we
on.
could change it on our like bio page and put pictures of our family and then pay
I
them
mean, yeah,
modeling
for
fees.
sure.
Like I remember when I was a kid, I'd go to my dad's office and file, like this is when they have file cabinets and
And
you'd
your dad
have,
was a surgeon,
he
right?
was, but like they'd
Yeah.
have like the stacks of
Hmm.
chart notes and stuff and I'd have to file them alphabetically
But you did
in the
actual
file
work.
cabinets. Yeah, and he'd pay me $5 and like buy me pizza.
Nice.
Um, yeah, so
I love it. Okay.
now there's no filing cabinets, and I don't know if you want your kids on your computer.
Mm-mm, I don't. Nope. Okay, one more thing. I mean, there are many, many more things. One more thing we're going to talk about. There are more like standard deductions for folks who are age 65 plus, and it does phase out after a certain income level. So, as retirees, you can potentially have less of your income taxed. So, not a ton of our clients that are retired already, but totally applicable in the future if this law holds up. And if you are already over 65, it's applicable now. But yeah, it's there's always going to be a mixed bag with any new big bills in terms of how it affects us individually. But it's a good idea to try to get a general understanding. And mostly this is going to be tax stuff, student loan stuff, and then the charitable giving. And I think to a certain extent, the Medicaid stuff may be a big deal for clients as well.
Yeah, we tried to cherry pick the things that we found that would apply to you guys. There's other components of
Hmm.
this act, just like any 800-page
Yeah.
act or tax law. There's going to be more to it, um, but yeah,
Yep.
these are probably the most pertinent ones for you guys right now. There's probably stuff that we miss that's pertinent to some of you, but
Hmm.
anyways,
It's evolving.
um,
Thank you for
that's
listening, everyone.
yeah. We'll
Yeah.
see you next time.
Okay. Bye.